Every single day, billions of people walk up to a machine, tap a screen, and move their money into a bank. It feels routine, it feels safe, but what actually happens next is something your bank will never explain to you. The moment your money enters that institution, it stops behaving the way you think it does. Not tomorrow, not after some review process. The second your deposit is confirmed, a machine starts running, one that makes other people extraordinarily rich. Banks are the most consistently profitable businesses in human history, and they built that wealth using your money. Today, we pull back the curtain on exactly how. That friendly smile across the counter when you make a deposit. It is not just good customer service. The moment a bank receives your money, a process begins. A quiet, legal, extraordinarily profitable process. That has nothing to do with keeping your money safe. Here is a fact most people never discover. If you could walk into the vault of your own bank right now, you would find it almost empty. Your money is not sitting there, waiting for you. By law, banks in most countries are only required to keep a small fraction of deposits on hand. The rest is gone before you leave the building. This is called the fractional reserve system. In many countries, banks are legally required to keep only 10% of your deposit in reserve. That means if you deposit $1,000 into your account, 900 of it is immediately available for the bank to use. Lent out, invested, working for someone else's benefit. And here's where it gets extraordinary. That $900 gets lent to another customer who deposits it in another bank, which lends out 90% of that amount, and so on and so on and so on. By the time this cycle completes, your original $1,000 deposit has been transformed into up to $10,000 of economic activity. All of it earning the bank interest. None of it earning you anything meaningful. This is called the money multiplier effect. $1 of your real deposit becomes $10 in the banking system. The bank did not create more value. They created more claims on the same money, and every single claim earns them a return. When a family sits down at a bank and signs for a home mortgage, they are borrowing money that originated from someone else's savings deposit. The bank charges that family 6, 7, sometimes 8 or 9% interest on money they received from depositors like you, essentially for free. When a small business owner needs capital to grow their operation, the bank lends your deposit at 15, 20, sometimes 30% interest. The bank bears minimal risk. If the borrower cannot pay, there are assets to seize. The upside belongs entirely to the bank. The downside belongs to the borrower. Your role, you are simply the source. This is the cycle. You deposit, the bank lends, borrowers pay interest, the bank profits. And in return for funding the entire operation, the bank offers you a savings rate that barely covers the cost of a monthly subscription. You provided the capital. You took the inflation risk. You received almost nothing in return. Now let us talk about the number that exposes everything. Banks in most countries pay depositors between 1 and 3% per year on savings, but they charge borrowers anywhere from 8 to 30% on loans. That gap is called the net interest margin, and it is how banks generate billions annually using money that belongs to you. The people running these institutions understand this gap better than anyone alive. Bank executives rank among the highest compensated professionals on earth. In the United States alone, the chief executives of the top 5 banks collectively earned over $150 million in a single year. Wealth built on the spread between what they pay depositors and what they charge borrowers. Think about what that means for you personally. You earn 3%. They charge 25%. That is a 22-point spread on money you handed them voluntarily, every single month for years without ever questioning it. And inflation quietly devours your 3% from the inside. In years when inflation runs at 4 or 5%, your savings account is shrinking in real terms. The bank balances their books perfectly. You absorb the full weight of purchasing power erosion entirely on your own. But lending is only the beginning. Banks do not simply lend your money and wait. They invest it aggressively. Your deposit funds, trading desks that operate around the clock. placing positions on equities, currencies, bonds, commodities, and derivatives across every financial market on Earth. The largest banks hold ownership stakes in hundreds of the world's most powerful corporations. When your deposit sits at one of these institutions, you are indirectly financing the portfolios of the ultra-wealthy. They receive the returns. You receive a statement at the end of the month with a very small number on it. Then there are derivatives, financial instruments so layered and complex that even the professionals trading them rarely understand the full chain of risk. Your deposit, multiplied, repackaged, sliced, sold, and leveraged again, travels thousands of miles from where you originally placed it, serving interests you were never told about, generating profits you will never see. Every layer of this architecture is designed to move wealth in one direction, upward, not toward communities, not toward depositors, upward, toward institutional shareholders, toward executives, toward the financial class that owns and controls the infrastructure your savings passes through every single day. You are not a customer to a bank in the way you have been told. You are a raw material. You are the fuel they burn to generate returns for their actual stakeholders, the institutional investors who hold the shares. Seeing this clearly is the beginning of making different choices. Here is the reality that keeps economists awake. Because banks only hold a fraction of deposits at any given moment, they are permanently, structurally fragile. If a significant number of customers decided to withdraw their funds simultaneously, the bank could not pay them. This is not theoretical. It has happened, and it will happen again. In 2008, the world received the most expensive financial lesson in modern history. Banks that had lent too aggressively, invested too recklessly, and leveraged beyond any rational limit, collapsed within weeks of each other. Trillions of dollars of ordinary people's savings, retirement funds, and lifetime wealth evaporated. Not because of anything depositors did wrong. When one major bank fails, the contagion spreads almost immediately. Banks lend to each other constantly through overnight credit markets. The moment one institution freezes, the trust holding the entire system together begins to crack. One domino, then another, then the chain collapses. And who absorbs the losses when the system falls? Not the executives who earned hundreds of millions making reckless decisions. Governments step in with public money to rescue the very institutions that just failed their depositors. The profits were always private. The losses get distributed to everyone. So what do you do with this knowledge? The first step is relentless financial education. Understand exactly where your money sits right now. Find your current savings interest rate. Compare it to your country's inflation rate. Ask yourself honestly, are you building wealth here? Or providing cheap capital to an institution that will never share its returns with you? Second, consider directing a portion of your wealth into hard assets that generate returns outside the banking system. Real estate, researched carefully and acquired with discipline, produces rental income, builds equity, and grows in value over time. Your money works for you, not for a board of directors you will never meet. Third, consider holding some of your wealth in stores of value that cannot be multiplied or diluted. Gold, silver, and select hard assets have preserved purchasing power across centuries of inflation and financial crises. They exist entirely outside the fractional reserve machine. They cannot be lent out 10 times over without your knowledge. They are yours, completely, without counterparty risk. The entire banking industry depends on you never asking these questions. It depends on you walking in, depositing, and walking away without ever looking at what happens next. But now you know. Share this with someone who trusts a bank without understanding it. Follow for more of what the financial system would prefer you never learn. Because we are only just getting started.